More often than not, we perceive and harbor a very ad hoc and arbitrary images about the corporate entities. It happens because they are not backed by the realistic corporate numbers, by realistic intrinsic value of the corporate, but they are supported by external perceived value about the corporates. And that is why such images which we harbor in our minds are called as falsified and fossilized corporate images. Therefore, to carry such a hypothetical, unrealistic, and fanciful images about the corporate entities is not a good professional habit. As a learned individual, we can resort to many financial and non financial parameters to identify and ascertain exactly the true worth and the true value of any corporate. Some number crunching professionals, they will carry out extensive and intensive balance sheet research, and surreptitiously they will try to unearth hidden and untold stories about the corporate. Some professional, they will walk through profit and loss statement, which is also called as income statement, and they will try to ascertain the operating intelligence, operating nitty-gritty, operating efficiencies or operating inefficiency about the company. Some professionals, they will catch hold of typical ratios, meaningful ratios to identify the real worth and the real financial health of any corporate. One such important financial parameter which is very much in vogue today and being highly utilized by the professional lobbyists as well as the strategic management thinkers is known as the top line and the bottom line of the business. So, what is the top line of the business? Every CEO, top layer management thinkers, they are expecting a top line growth for their businesses. Top line is nothing but the gross sales and the gross sales revenue which the company has garnered. If the company is witnessing a healthy top line growth, that means quarter on quarter basis, year on year basis, the sales volume is increasing. As a return, total gross sales revenue is also piling up. However, it is important to note here is that the top line growth of any company cannot be viewed in a quarantine angle because there are host of other factors which are instrumental for giving a big push effect to the corporate sales story. Such key factors, they are essentially the drivers of corporate top line growth. They may include state of the art, sophisticated technology, technological collaborations, technological tie ups, quality consciousness, customer satisfaction, customer retention, so on and so forth. Now, because of sustainable growth in the top line, the company's sales numbers are kissing the roof. The company is registering a massively attractive sales revenue on quarter to quarter or on year basis. Now, the question is that whether this sales income or sales revenue, is it the profit of the company? The answer is that it is not the profit of the company. Emphatically, it is only a gross sales revenue. So, why it is not called the net profit of the company? Because from the gross sales revenue, we subtract certain kinds of expenses. And broadly speaking, in a corporate life, there are two major types of expenses. These categories are operating expenses and financial expenses. First, operating expenses. These are the expenses which are incurred for the smooth and hassle free day to day operational activities of the business. For example, purchase of raw material, payment of salaries and the wages, expenditure on sales promotion, logistic, marketing, research and development, expenditure on utilities, payment of interest charges to the bank, so on and so forth. Naturally, the quantity and the quality of operating expenses depends upon the operating canvas of the company. It also varies from industry to industry. If the operating canvas is very large, very huge, then operating expenses will be towering. For example, the world's largest refinery is in India, owned by Reliance Industries Limited, situated at Jamnagar. Operating expenses for such refineries is always very huge, whereas for pharmaceutical industry the operating expenses are less. For pharmaceutical industries, expenditure on research and development is only a one time fixed cost. But once a new drug, a new formulation is invented, then the manufacturing of that drug doesn't entail too much of operating cost or too much of variable cost for the pharmaceutical industry, and that is why for refinery industry the operating cost is always very huge because of the spread of the canvas, whereas for the pharmaceutical industry, because it's being a typical nature, the operating cost is always minimum. Similarly, when the operations of a company are labor intensive, depends more and more on manpower and less degree of automation, in that case operating expenses will be large. Similarly, if the company is capital intensive, degree of automation is more, use of robotics, artificial intelligence is more, in that case organically the operating expenses will always be less. Similarly, quality of management, quality of supply chain management, quality of workmanship also determines the size of operating expenses for any company. Now, the another type of expenditure which we subtract from the gross sales revenue or from the top line of any company, that expenditure category is called as financial expenses. These financial expenses are nothing but the payment to the government, statutory payments. For example, the payment of GST, which is indirect tax, payment of corporate tax, which is a corporate income tax, which is hovering in the range of 30 to 35% in India. Then other types of penalties, the payments which are made to the government, they all come under the financial expenses incurred by any company. Here you will realize that out of these two expenses, the corporate can exercise a solid control and expected control over operating expenses, because it is the quality of the management which can decide upon, which can exercise, and which can lay a solid grip over its cost structure. However, insofar as the financial expenses are concerned, the corporate has literally no control over it, because the rates of taxes, they are already determined by the government concerned. In this manner, from the top line of any company, or from the gross sales revenue of any company, we subtract operating expenses as well as financial expenses, and then what residual amount we get, what balance amount we arrive at, that is the net profit, and that is the final profit of a company, and that net profit is called as the bottom line of the company. Sometimes, ironically, it happens that despite of witnessing a healthy top line growth, the bottom line of the company turns out to be poor. Naturally, because the cost structure of the company is rising. The company do not have any control over the operating expenses, and that is why despite of robust and healthy top line growth, the bottom line is almost flat. Conversely, it could also happen that despite of poor or mediocre top line growth, the company will be in a position, the company is in a position to keep its bottom line by and large intact, because the company has exercised a better and stringent control over its operating expenses and over its overall cost structure. In this manner, the top line and the bottom line financial phenomena is an important barometer to ascertain the quality of performance of any company. So, instead of surmising, instead of resorting to ad hoc opinion mining about the corporate entities, we can make use of the top line and the bottom line of the business as an analytical tool, so that we can have our own conviction with regard to the quality and the performance of any company. Thank you so much. Have a happier day ahead. Thank you.